I was doing some research this morning and I ran across this blog post by Ben Carlson, who writes A Wealth of Common Sense and is also the host of the Animal Spirits podcast and someone I personally respect in the finance and investing space, on 8 of the biggest investing myths. And just a few weeks back, I did a video on the biggest myths of investing, or the biggest myths of finance, that I felt that have personally hindered me in my 10 to 12 years of investing experience. So anyways, I wanted to go through this blog post, turn the camera on, and just kind of create like a little reaction video with my opinion and anecdotes on what he thinks are the 8 biggest myths of investing. So I haven't read this before, so I'm going to scroll down the page, read some parts out loud, and then probably drop my 2 cents on them. Here we go. Okay, so so it looks like he's got like a slideshow on it. I'm going to skip by that. And fortunately, we've got him kind of listed out. Myth number 1, you have to time the market to be successful. Yeah, I would say this is a pretty good myth. I know somebody, a friend of mine, and she was saying, well, my stepdad, her stepdad is a financial advisor, and he says now is not the time to put money in the market. Things are too high. And I'm like, why? It's generally better to get money in the market and over a long period of time, the appropriate time horizon, 15 to 20 years in equities, you will see positive returns, right? Myth 2, you should wait until the dust settles to invest your money. Okay, this one is something that really sticks to me because I know personally, going back 10 or 12 years when I was in my early 20s, I was looking at things. I'm like, this is just a bad time to invest in them. Invest, right? There's just all these big calamities that are going to happen. Well, the reality is there's always a big fucking calamity, a big fucking rain cloud lingering overhead that's giving you a reason why you shouldn't invest your money now. You will, if you wait until the dust settles, you will be waiting forever. All right. This is interesting. Okay. I haven't seen this before. Unemployment rate above 9%, stock market returns 24.5%. I guess you could blame everything that happens on the Fed, but look at this chart I pulled out on the annualized returns at different unemployment levels. No, I'm not sure what time period they're looking at for annualized returns. It's like 5-year returns, 10-year, 1 year. I don't know. But there's some data behind it. In an effort to keep the video moving along, I'm not going to, and try to interpret the charts. I'm just going to keep moving here. Myth number 3, just wait for things to return to normal to invest. Okay, well, this is like just waiting until the dust settles, right? There is no normal. There's always some weird extenuating circumstance that's happening. Our debt is ballooning. The price of gold is falling. The OPEC is going to constrain our oil. There's a nuclear bomb that's going to hit the United States. Maybe that's a little bit ludicrous, but there's just always something crazy that's going to happen, right? So the best thing to do is just keep investing. Myth 4, a higher yield makes for a safer investment. Okay, this is the average dividend yield for AT&T going back to the turn of the century. Okay, 5%, not bad, right? AT&T generally produces a high dividend, right? Well, now here's the price chart, okay? And we can see the price over that time period is going down. So rather than fundamentally, I guess this is all going to be kind of fundamental and theoretical, rather than reinvesting their profits and growing the business, AT&T is just distributing their dividend. And ultimately, that's kind of coming at the expense of their stock price. So yes, they're paying a dividend, but you're losing money on that, that nest egg, that actual equity holding. So I totally agree with this. A higher yield makes for a safer investment. It annoys me when I see people hyping up dividend stocks. And I know this is real popular on YouTube because I surf and I linger on YouTube, and I always get hit with like the 10 best dividend stocks, or look at my dividend portfolio that generates 7.2% annually, right? Well, yeah, it generates fucking 7.2% annually, but your total portfolio value is going down because these stocks are not appreciating in value. You would be, in most cases, like 99 out of 100 cases, you would just be better investing in the S&P 500 and making your own dividend out of that if you want stocks. And I say making your own dividend, I mean just, liquidating a portion of the holding that you need. Myth 5, new highs means the stock market is going to crash. The decades, I know it seems scary when the stock market is at all-time highs because one of those highs will be the high before a bear market, but all-time highs are perfectly normal. So over the last 100 years or so, 1 out of every 20 days the market has been open has closed at an all-time high. Yeah, I remember back in 2015, I think in 2014, we started seeing the S&P 500 recover, and reach all-time highs from where it had been before the great financial crisis. So in 2015, I was just certain the S&P 500 is going to crash. I remember that, and I remember not putting money in the market. I had some in there, but not as much as I should have. And I was keeping a lot on the sidelines because I was certain we were going to have another 08-09 style crash. And since then, I think the market has returned like 150%. In that year, once I saw things start taking off in 2016 and 17, it really kind of, just slapped me in the face and slapped me hard that crashes are, not regular events, and time in the market beats trying to time the market and waiting for crashes. Myth 6, the stock market is like a casino. Whenever the stock market falls, it feels like the powers that be are out to get you. People always compare the stock market to a casino when they lose money. This analogy has never made sense to me either. At the casino, the longer you gamble, the greater your odds are of walking away. The casino has better odds than you. It's math. But in the stock market, the longer you invest, the greater your odds of success are. I think this needs to be prefaced by saying, the longer you are invested in broad market funds, the greater your odds of success are. Primarily index funds, but I'm not saying that active funds are bad as long as you have diversification. The problem is where you really kind of up your risk is just holding individual stocks, and individual stocks that are small cap individual stocks, value stocks as well. Yeah, I mean, if you're broadly diversified, you really don't have risk. But when people start getting into one stock, or they start kind of day trading or trying to chase meme stocks, you know what I mean? That's when things really get into it. I guess meme stocks are more risky than a casino, probably, or maybe not more risky, but they're about damn near as close to as risky as a casino, day trading and all that. But broadly speaking, the stock market, I guess market being the key word here, it is not like a casino at all. The more exposure you have in it, the longer you hold it, the better you do. Myth 7, risk is quantifiable. This is a big one here. Risk is quantifiable. Because a lot of times when we're talking about risk from a quantitative perspective, the go-to metric is always standard deviation and then drawdown, right? A lot of times, and I do this too, because it's really the only way to quantify it, because it's not quantifiable. Our best attempt is looking at standard deviation. We'll look at the standard deviation of a fund or a strategy and be like, okay, this is risky, this is not risky, or this is more risky than the S&P 500, it's less risky. But at the end of the day, risk is really not quantifiable. There's two things I think that most investors feel for risk. Number one is volatility. When things get volatile, people start feeling like, okay, maybe I should go to cash, maybe I should get out of the market, or they just kind of start feeling uneasy with their equity allocation. And then when there's drawdowns, but you really can't quantify it. It's really hard. It's so hard to even explain and comprehend. Let's just see what Ben says on it. My problem when working in the institutional investment complex was everyone's over-reliance on math equations to define risk. Okay, I mean, that sentence says a lot right there. I'm recording this in February 2022. In January 2022, we saw basically all asset classes go down. The NASDAQ is in like a 30 or 40% drawdown over the last 6 months. Some people are calling it the everything bubble. Basically, all asset classes have gone down over the last few months, except for commodities, right? But they haven't gone down very much. And volatility has increased a little bit. But personally, I feel scared. I feel very risky. But there's no way you could have quantified that. I just feel like it's risky because, hey, we've been in a big bull run. Things are getting a little sketchy now. And oh yeah, the Fed is raising interest rates. and real estate prices are out of control and inflation is out of control, right? So I feel risky. I feel scared. That is my risk. But you can't quantify that. Like, I just cannot put that into numbers. I understand the need to benchmark, and risk-adjusted returns can help investors get a better handle on what's going on in a portfolio strategy, but over-reliance on a quantitative measures can be a deterrent if you assume it can help you predict what's going to happen in the future. While I am a data junkie, there has to be a qualitative aspect to investing as well. Buffett once said, risk comes from not knowing what you're doing. Richards wrote, risk is what's left over when you've thought of everything. For individual investors, these are the only two questions that truly matter. Am I on track to reach my financial goals? How do I minimize the probability that I won't reach these goals? You can never give yourself 100% assurance on these questions. Yeah, it's very true. Risk is quantifiable. I mean, I don't know what else to say. It is not quantifiable at all. Myth 8, I like this one. I already skimmed it with my eyes before I read it out loud. Complex problems require complex solutions. Let's say you have a $1 million portfolio. This is the annual income you would earn on this portfolio if you would put the entire amount into 10-year treasuries over time. Okay? And we can see, 1960, 47,000, 1980 spikes up. Now, okay, so I'm guessing it's looking at the yield. Interest rates are rising, but they're still lower than they've been 99% of time. Because of this low rate environment, there'll still be plenty of investors and salespeople pushing for more complexity to make up for paltry yields. But when you boil it down, there are really only two options for investors. Take more risk or lower your expectations. Yeah. And to kind of elaborate on this, complex problems require complex solutions. This applies to portfolios as well. I just did a video on the Bogleheads 3-fund portfolio. What if you invested $1,000 a year in it for the last 25 or 30 years? Basically, we can see that it outperforms most complex portfolio asset allocations. Just doing a simple 3-fund portfolio and rebalancing annually to your target allocation will outperform the same allocation no matter how you slice and dice it and break it up. I also did another video on smart beta and factor investing. And, I was saying, hey, back in 2015, everyone was all about factor investing. Here are the back tests that they were showing in this document in 2015. Now, how have they done? Because it was by S&P Global, and now they've subsequently launched. That was before they launched the equivalent factor investing funds, and they were showing all of these good back tests. How is that done going forward? Subsequently, it hasn't performed very well. In the investing world, simple tends to win. A simple low-cost 3-fund portfolio is going to probably outperform like 90% of any asset allocations that people come up with using the efficient frontier model, the CAPM model, Black-Litterman model, mean variance optimization. All of these models for going forward are, quite frankly, utterly bullshit, when in reality, a simple portfolio does just as well. And something else I see frequently is people on Reddit. I linger on Reddit sometimes. People go on there and they will say, hey, I've got a windfall of $2 million. What do I do? I've got an account with Vanguard right now and I do a 3-fund portfolio. Should I go to another asset manager, that's going to do something amazing and get me better returns? Or should I leave a Vanguard, manager and go somewhere else, go to, Goldman Sachs? I don't know if Goldman Sachs has individual advisors, but anyways, they're looking for a better solution because they have more money, when in reality, simple wins. So that is 8 myths by Ben Carlson, and my reaction, my anecdote, my 2 cents, and my opinions on these 8 myths. What do you guys think about these 8 myths? Is there anything I left out? Is there anything you feel like I should have touched on? Let me know in the comments below. I'm signing off on this one, guys.